David R. Guttery is the president of Keystone Financial Group in Trussville, Alabama. David Guttery and Brandon Guttery are financial advisors and represent Emeritus Investment Company, LLC. Please stay tuned through the end of the video for additional important disclosure information.
Hello, clients, and thank you for spending some time with me to receive this last podcast of the year. As you know, throughout this year, we've leveraged a myriad of tools in our efforts to maximize effective communication. Our monthly videos and emails are really useful for passing along very high-level information, but these podcasts enable us to dive more deeply into the granular level of economic data and why it's meaningful to you in terms of the planning goals that we're pursuing. So if you'll bear with me for a few minutes, I'd like to briefly reflect on the previous year before looking ahead to the opportunities and the risks that might be in front of us. For starters, I would like to recognize some people who have enabled our working relationship to continue as seamlessly as it has this year. These are unsung heroes that deserve recognition for what they've accomplished this year. So first, I'd like to thank our leadership at Emeritus, an Emeritus Investment Company, for identifying ways to safely run a national financial services company remotely and for investing the capital that was necessary to make that happen so that we in the field could discharge our responsibilities without disruption and our home office colleagues could support us safely in that endeavor. In short, what they've been able to accomplish is nothing short of a heavy lift miracle, and I can't even begin to describe how beneficial that's been to us as we've been here for you during this year. So bravo, Emeritus. Very well done. Secondly, I'd like to put my administrative assistant, Meredith, and my newest associate, Brandon, on the highest pedestal that I can find. 10 months ago, we developed a multifaceted strategy for one purpose, and that was to maximize our contact and our services deliverable to you, our clients. Now, this enabled me to spend the majority of my time in meetings with you and on market and economic information research and the daily management of investment accounts. Brandon and Meredith are instrumental in making sure that performance reports and meeting materials are not only prepared but accurate, and tasks are discharged, and meeting schedules are set weeks in advance. Paperwork is completed and facilitated, and a host of other things. In the process, we've accelerated our meeting schedule to a 45-day loop rather than the 90-day loop. In terms of lives that we've impacted this year, by the numbers, we have had a 300% increase over last year. 1 year ago, I never would have dreamed that what we've accomplished as a team this year was even possible. Third, I would just like to put 2020 into some relative context. On the 16th of December, I celebrated my 29th anniversary in the practice of financial planning. Now, this year brought quite a few firsts that I had never seen over the previous 28 years. Until this year, I had never seen the 10-year Treasury yield at 41 basis points. And hopefully we won't see that again. I have never seen a crude oil futures contract close at negative $50 a barrel. I've never seen the Federal Reserve print $7 trillion in less than 2 months. I've never seen the M2 money supply expand by over 30% in less than a year. I've never seen GDP drop by over 30% in 1 quarter. Then again, I've never seen it rise by over 33% in a quarter either. I've never seen the market drop by 38% in 6 weeks and then rise by 67% from that market low all in 1 calendar year. I have never seen multiple vaccines developed from start to finish in a matter of months rather than years. I've never seen the economy turned off as though it were a light switch. I've never gone this long without giving my parents a hug. And I surely never thought to coordinate a mask with my suit. I never thought I'd be holding the majority of my meetings virtually either. What a strange year. You know, I could go on, and you can certainly add your own examples of things that you've never seen before to the end of this short list. This year has tested our mental toughness, our emotional capacity, and our resolve to fill the unforgiving minute with 60 seconds worth of distance run. It has impacted us financially and physically, but here we are. Each day reminds us that we are stronger than we were the day before, and somehow we muster the energy and the strength to meet the continuing and the new challenges. One thing I've learned about extended periods of stress is that they act as crucibles to refine and purify. But for the necessity of learning how to achieve better results through different means, would we ever do so? While I'm anxious to welcome the new year and the opportunities that it will bring, I am also going to choose to focus on the positives that have resulted from such a taxing year. We've learned how to work more efficiently and in the process do more research, stay in more frequent communication, and discharge our responsibilities to you with greater efficacy. And in the process of doing that, in our office anyway, we have redefined what it means to work as a team. From the home office level to the field office level, we've invested in and acquired technology resources that have forever changed how we do business on a daily basis. We've moved the ball forward, and in a year that may have otherwise withered us into a shell, we meet challenges head on, and will continue to do so because that's what you expect from us, and that's our commitment to you. So having said all of that, let's dive into the threats and the opportunities that lie in front of us in the new year coming up. Throughout this year, we have observed many economic metrics as we've monitored the progress of the recovery from the shutdown earlier in the year. As it stands at the end of the year, many of these economic metrics continue to reflect very positive results and robust momentum. So let's begin with a quick overview of the Purchasing Managers Index. Now, I know this graph looks busy, so at a high level, just remember that any reading above 50 is indicative of expansion. We now have 6 consecutive months of expansion on the industrial side of the United States economy. We see similar trends throughout the Eurozone and the Pacific Rim. The momentum of industrial expansion continues to strengthen. Now, we can cross-check that with what we see in the global PMI readings with such things as new orders for durable goods. Over the last half of the year, demand for big-ticket durable items has been exceptionally strong. In December, we learned that this metric increased by another 0.9% in November, and this trend only seems to be gaining in momentum. Now, I believe that the confidence being expressed by consumers is directly tied to the millions of jobs that have been created since April of this year. As you've heard me describe before, the 4-week moving jobless claims average is a good indicator of what we might see within future reports about jobs creation. There is no question that hundreds of thousands of people remain unemployed, and for reasons that largely lie beyond their ability to control, such as a local government that either restricts or will not allow a person's place of employment to fully open, if at all. Nonetheless, we have indeed created over 17 million payrolls since April of this year, and those people have expressed their confidence through their patterns of spending behavior that we can cross-check with other metrics. Now, we have already seen very strong patterns in consumption of durable goods, and over essentially the same period of time, we have seen demand for housing equally robust. Indeed, the inventory of available homes seems to be the only thing holding this metric back. I've heard of numerous examples where prospective home buyers have outbid each other for a desired house during a time when inventory was slim and interest rates were compelling. Interestingly, we have also seen historically robust readings on housing starts. So this tells me that when people do not find that for which they are looking, they build it. The housing starts for October and November were stronger than any other month seen since before the Great Recession in 2008. And again, neither of these metrics are showing signs of deceleration. We can also observe the confidence of consumers and their capacity to spend by looking at retail sales, excluding food and services. Given the dramatic impact of COVID-19 on the restaurant industry, to truly gauge the degree by which retail sales have shown strength, we need to observe that metric while excluding food services. You can see on this graph where we are and today and when the economic shutdown occurred, and how strongly we have recovered in this area of consumption. As I mentioned in the opening monologue, I have never seen real GDP growth below 30% in a quarter while being above 33% in the following quarter. The metrics that we have observed, however, are responsible for what you're seeing here. This is real GDP growth, and according to the Atlanta Federal Reserve Bank, the outlook for the fourth quarter seems robust as well. So if indeed we see the annualized 11% rate of GDP growth as forecast by the Atlanta Federal Reserve Bank, then for the year of 2020, we could have a positive annual rate of GDP growth. If we do, then this recession will go down as being the worst in economic history, as well as the shortest. Again, what a strange and unusual year. You have often heard me draw reference to the TED spread. So again, at a really high level, this graph is simply the result of the actions of the bond market participants. The tighter the TED spread, the more the bond market is telling you that it sees strong economic conditions, both for the present time and into the future. The bond market is also a discounting mechanism, just like the stock market. Clearly from this graphic, we can see that at the present time, with a 12 basis point TED spread, the bond market perceives not only the strong economic conditions that we have just discussed, but also the apparent belief that such conditions will continue into the future. So this brings me to the graphic of the stock market. And again, you've seen this on many occasions before. We have established new all-time record high levels across all three stock markets. I can give you a myriad of solid economic reasons for being invested at this time. Nonetheless, we must be mindful of threats to economic expansion and thus the potential for adverse market movement and the repricing of risk in response to those disruptions. So this is a sanitized way of suggesting to you that, in my opinion, I do not believe that either the stock market nor the bond market has priced into itself the impact of that which President-elect Biden has suggested in terms of fiscal and economic spending initiatives, nor dramatic changes to the tax code. I have often said that equity and debt markets are discounting mechanisms. What that simply means is that both markets are taking into account information that is available today and using it to discount the future. Said another way of the stock market, if company XYZ is trading for $100 today, then it is partly because the market believes that company XYZ could be trading for $125 in the near future. That is a function of consumerism, higher velocity of money, resulting in greater demand for the product that the company makes, thus resulting in higher revenues and earnings and supporting higher future asset valuation. To what degree can we truly rely on the assumption of higher velocity of money, resulting from increasingly greater spending, if both corporations and individuals are left with lower amounts of net spendable income with which to consume? Because the stock market is again at an all-time record high, then by extension we can assume that the market has priced into itself much about the future. Furthermore, we also know that we live in a world of high-frequency trading, where algorithms can trigger and in the process trade millions of shares of a widely held stock in a matter of nanoseconds. What we saw earlier this year was, in my opinion, a melting cascade of such algorithms in response to the economic shutdown induced by COVID-19. So do I believe that we have the potential for significant volatility over the short term? Yes, I believe that we do. But that also depends on other things happening that may act as a catalyst to precipitate that volatility. On this graphic, you're looking at the velocity of money for the 8 years under the Obama administration. Now, I drew reference to this graph several months ago when we were discussing the primary election. We know that under the tax, fiscal, and economic spending initiatives of the previous administration, companies were incentivized to hoard cash, and that resulted in a declining velocity of money. And you can see that on this graphic from the St. Louis Federal Reserve Bank. We are also able to cross-check this by looking at the amount of cash on hand in both the retail sector as well as the manufacturing sector. There is no argument that under the previous administration, for 8 straight years, companies were incentivized to hold on to their cash, which resulted in a lower velocity of money, which in turn resulted in 8 straight years of very tepid economic growth. So my fear is that the market has not priced into itself the future asset price valuations under such different economic conditions. Will the velocity of money continue to be stronger if the top corporate tax bracket is raised to 28%? Can it possibly move higher with a 12.4% FICA tax on incomes above $400,000? How might the change in tax treatment of capital gains disincentivize consumer behavior? We haven't even begun to factor in the impact of a Green New Deal, tax penalties on repatriated U.S. dollars, and what is now being called Biden Care as the replacement to the Affordable Care Act, which by many measures was a driving factor behind the previous 8 years of corporate cash hoarding. So let me say this another way. If the market is pricing into itself the thought that corporate capital expenditures and individual consumerism will continue as the economy continues to recover, and as a result, demand for products and services will continue to increase and revenues and earnings will look better as a result, if indeed what we see is declining velocity of money and the incentive to hoard cash again, will that result in lower demand for products and services and by extension lower than anticipated revenue and earnings? And if it does, then to what degree do you think the market may have to adjust, if needed, if it has priced the opposite into itself? We know that as markets move higher, buffers around algorithms become tighter. We know that we are at a new all-time record high and at the end of a tax year where no one is incentivized to lock in short-term capital gains. So on the second trading day of the new year, the 5th of January, how might 2 otherwise innocuous Senate runoff races impact the direction of the market? Frankly, it could be dramatic. The only thing that potentially stands between continued strong consumerism or a completely different economic picture is gridlock in Washington. Without gridlock, then it is entirely possible that everything President-elect Biden has discussed could come to fruition in terms of tax, fiscal, and economic initiatives. If that happens, in my opinion, the market has overly valued the potential for future asset prices because the consumerism will likely not be there to drive the revenues and the support of higher prices, just like it wasn't there between 2008 and 2016. How quickly might the market respond to reprice the risk of being potentially overly valued? In this day and time of algorithmic high-frequency trading, it might not take more than a few days or weeks. We've already seen this once before, just earlier this year, what a melting cascade of algorithms looks like. So let me be clear by saying that I am not suggesting that this will be the most likely outcome. In fact, I believe that it is much more likely that we indeed will have gridlock in the Senate. If we do, then I'm not sure that the market pauses at all. With gridlock, many experts are suggesting that President-elect Biden and his administration will have a very difficult time passing a sweeping overhaul of tax and spending initiatives. If we don't have gridlock, however, then I think the markets will adjust to the negative potential impact on GDP as a function of lower spending, lower velocity of money, and the potential for lower revenues and earnings and thus lower future asset valuations. So what do we do about it? Well, I guess a better question is, what have we already done about it? If you're one of our managed account clients, then we have already spent much time discussing the stop-loss good till canceled orders and the options collars. If you're an equity indexed annuity client, then we have discussed the principally guaranteed nature of your contract. If you're a variable annuity contract holder with a volatility managed portfolio, then we have discussed how that is designed to hedge against overly volatile periods of time. Honestly, there are risks with any given course of action. For those people who may be inclined to cash out and see what the first few weeks of the new year might bring, there is the risk that we do get the gridlock for which the market is looking and you return to your invested positions at a 10% premium. So in conclusion, and you've heard me say this ad nauseum, we try to be proactive in everything that we do, in all that we can, and as often as we can. Sure, there are some things in life that are acute shocks, and you've got to respond to those things. In this case, however, we have tried diligently to proactively plan for both the risks and the opportunities that may lie before us, and as a function of the tool that we have employed for the implementation of your financial plan. Being proactive means constantly absorbing economic data that changes by the day from a wealth of sources. It means being in frequent contact with you. It means being mindful of the goals that we have established and the strategy that we have employed in the pursuit of those goals and the risks that are inherent with the strategies and of all of the things that we need to do with the information that we have to prepare you for meeting those challenges. If the economic landscape changes dramatically, then we will adjust. There is no such thing as an autopilot setting on an investment account. There will always be something to buy relative to the economic conditions at hand as we continue to pursue the goals that we've identified. If the economic world throws us lemons, then we're going to make lemonade. Now, look, I know this has been a long podcast, and thank you again for your time in receiving it. Please know that we carry your hopes, your dreams, your fears, your aspirations with us every minute of every day. It's what you've hired us to do, and we don't take that responsibility lightly. We hope that you have a very happy new year, very healthy and safe celebration. Back in March, we talked about getting through this together, and we've certainly come a long way toward that end. There is so much about which to be optimistic, and we are. Along the way, we will be proactively mindful of the risks as we embrace tomorrow's challenges. Thank you again, and we will talk to you again in 2021.
David Guttery and Brandon Guttery independently offer securities and investment advisory services through Ameritas Investment Company, LLC, member FINRA, SIPC, and Ameritas Advisory Services. Information provided in today's segment is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed and should not be interpreted as tax or legal advice. Any performance stated is past performance and is not indicative of future results.